Welcome to Money with Mark Albert. Really appreciate you being with me. Today we're going to focus on the Bank of Canada because today being July 10th, 2019, the Bank of Canada, they made an interest rate announcement and we're going to look at that. They also talked about their monetary policy, but we're going to focus on the interest rate announcement. I will say this, that if the Bank of Canada rate announcements are important to you, please subscribe below because I will continue to do this every time they make a rate announcement. There's another 3 more that they're doing this year, and so this may be of interest to you. We're going to look at what they decided, but also reasons behind that and what they're looking at moving forward. I trust it to be a valuable use of your time. Thanks for being with me. So they decided they would maintain the rate, and you'll notice here is that all year they've maintained the rate going all the way back to December 2018. They've maintained it for 6 rate announcements. If you look to last year, they increased it only 3 times, in January, July, and in October, and each time was 1/4%. Now, even though the rate has been maintained at 1.75 for this many ongoing announcements, you'll notice a 5-year fix on mortgages has continually decreased, and that is because of the bond yield in the markets. They've been decreasing, and as they decrease, so does the 5-year fixed mortgage. And so you'll notice you get a 5-year fix today at a better price or interest rate than you would even a 5-year variable rate mortgage. So we'll keep an eye on that for us as well. So let's take a look here. So some of the reasons why, some of the things they're thinking about is there's ongoing trade tension, and it's having an effect on the global economy in terms of the outlook. And as they look forward, they just see a lot of trade conflict. So it's making things a little cloudy for them, and so it's a big thing on their radar. So trade conflict between the U.S. and China in particular is curbing manufacturing activity. It's also curbing business activity and purchasing or pushing down on commodity prices. And so this is creating a bit of a problem, and you'll notice the tension with the U.S. and China. It's not like it's getting better at all in terms of their ability to agree. So this is something they got a close eye on, but it's not the only conflict in terms of trade negotiations around the world, but it's the biggest one. So also there's escalating trade conflict, but as a result, it remains the biggest downside risk to the Canadian economy as well as the global economy. So, you know, that's the type of thing where, you know, they keep moving tariffs up, which impacts trade, which impacts the cost of goods, and all of a sudden the economy continues to slow more and more. So these trade conflicts have the ability to really significantly hurt the outlook, and so this eventually has to come to resolution, of course. So these trade conflicts and competitive challenges are dampening the outlook of trade and investment, and these are some things on their radar. Now, we talk about real GDP. There's growth that's pretty good in Canada, and what they're saying is they're projecting real GDP average about 1.3% for this year. Now, the target rate that they try to keep it at is 2%. That's their target rate, and they're expecting that it would be around 2% for 2020, 2021. So as a result of them feeling that down the road, a year to 2 years from now, so they set the interest rate, they modify the interest rate so that it impacts the future, right? It doesn't impact like today. So they feel they're maintaining the rate because they feel that from a Canadian GDP growth standpoint, from an inflationary standpoint, we're looking pretty good at 2%. They want to keep it between 1 and 3%. Back in the 1990s, 1990, 91, they decided that they would do this type of thing so that they could keep it at that 2% long term. And that's been about the average since about 1990. So in the 1970s and 80s, inflation was so high, averaged about 7.6%. And so they needed to kind of curb that so they'd have some control and be beneficial to the economy, making business decisions and so on. So the bottom line on decision to maintain the rate had to do really with the global economy, commodity prices, and trade conflict. Those are the big issues for them. So the Canadian economy returns to potential growth. We talked about getting to that 2% inflationary rate for Canada. So the data that they have, and let me tell you, they go all out on data. That's their world. It's data. It shows the Canadian economy returning to potential growth of 2%. So as they look to the future, not for 2019, but into 2020, they feel good with that. The outlook is cloudy, as I mentioned earlier, about the persistent trade tensions that are out in the world. So that's the big kicker, I think, as they evaluate. But moving forward, Bank Canada, they'll pay particular attention to developments in the energy sector, right? The energy sector, and the impact of trade conflicts on the prospects for Canadian growth and inflation. So they want growth to be maintained, they want inflation to be around 2%, and they feel pretty good that going into 2020, 2021, that we'll be at that, they call it at balance. So they feel they'll be at a point of balance with inflationary targets. So just to say, please subscribe below. We got 3 more updates this year, September 4, October 30, December 4. Now, you'll notice we're moving into the, in the summer months, we want to move into the real estate season of the fall, so they make 2 decisions just kind of in that early part of the fall. They mentioned also that real estate, it's been looking better this part of it, moving into this part of the year. Interest rates have come down on the 5-year fix, and that's had a positive impact, people qualifying for stress tests and so on. So listen, thank you for being with me today. I trust it's been helpful to you. Have a wonderful day, and look forward to talking to you soon. Bye now.